In today's market, it can be easy to feel discouraged after watching your account shrink every day after day after day. For some, this may even lead them to questioning, am I doing everything right in my investments? The great part about investing is that it really doesn't have to be as complicated as you have always thought, or many have probably made it seem. I want to go through 4 steps today in this episode that you can make so that you can start keeping investing simple. While the market can't guarantee anything, these 4 steps, when followed, have shown great success in building an investment account that anyone would be proud of. Here we go.
Welcome to the Financial Mirror. Where future success is reflected in our knowledge of fixing the one thing we can control, ourselves.
Hey, what's going on? Hopefully everyone is having a phenomenal weekend. This is another episode of the Financial Mirror, and I could not be happier to bring it to you today. If this is the first time that you have found me, congratulations. Hopefully that this turns out to be everything that you expected, everything that you wanted it to be. And this is a place for you to come and really spin up and stay knowledgeable on your investments today, but ultimately just your personal finances. So if you're listening to this on a podcast platform of your choice, thank you. And don't forget to subscribe, like, comment, and share on those platforms. And if you have found me on YouTube or Facebook, thank you once again. And like, sharing, and comment is there as well. So that is applicable for you as well. So today's episode is coming at a pretty relevant time, and I have to say that I snuck this one up. This one is one that I had wanted to do, and it's one that I think is now more relevant, and so I wanted to sneak it to the top and ensure that we were going to discuss this in depth. And instead of originally this was just going to be talking about how to keep investing simple, I decided to make this an actual 4-step process so that if you will implement these 4 steps, I'm telling you, you will be on your way to really taking off with your investments. So without further ado, we're going to jump in and get this party started. So in today's episode, if you are like many, you are for sure looking at an account every single day, and you literally start your day, you hear about another down market, then you go back and you're like, well, let me look at my account, and then you just sigh because it continues to go down every single day. It seems like it's going down further and further, and we have to wonder where the bottom is. The great part about the market is no one knows. So we're going to get to that in a little bit in step 1, but no one knows, right? Like, no one knows where the bottom of the market is. Like, it's a movable goalpost that no one can really define. But every day when you're waking up and you're seeing your account shrinking, especially if this is hard-earned money that you've put in, it can definitely be difficult to look at this account and then see it just shrinking over and over and over again. If you are a new investor, and I say that because I think a lot of investors or traders or whatever, I think they got into it during COVID. I think there was a huge boom in the market in terms of activity, people getting involved in the market. And if you're a new investor, this might be the first bearish trending market that you've ever seen, especially if you jumped in during COVID. And we've been on this just furious run straight to where it topped out at. Or maybe you've been investing for a while and this is something you haven't felt in a while, right? Either way, it brings out an emotion that it shows how emotional investing really is. And I think that's the part that we want to get to. So looking at the screen, if you're watching this on video, but if you're not, if you're listening on the podcast, the market year to date is down 18.14%. So 18%. So the market on average, this is the S&P 500 index that I'm looking at. On average, this market is returning 10% a year, right? And we're down almost 20%. So you can see how that's impacting, right? Like you can see how it's almost like 2 years of gains almost in the other direction, right? Uh, and this is, and we're only in May. Like this thing could keep going down. That's the part that's really hard to get your head wrapped around. But investing is emotional, and that's the part of this, is that you see this every day in this emotion. You put your money in this account, and every day it's either worth more or less, right? And here recently, it's really just been worth less. Every day you're putting money in, and it's worth less. So how do we combat that? How do we go through and say, okay, this is what I'm supposed to be doing, right? Everyone's told me I'm supposed to invest. Everyone's told me I'm supposed to do this. I'm supposed to do that. How do we combat that? How do we really navigate that aspect of the market? And how do we ensure that what we're doing is correct? So when these negative emotions creep in and you're like, man, like I just don't know if I'm doing the right thing, that can be tough. But just remember that most likely you are doing the right thing. And I want to say that up front. Most likely you are doing the right thing. And you're going to hear these 4 steps, and hopefully it either solidifies that you're doing the right thing, or if this isn't what you're doing, or maybe you're not investing currently and you're like, well, I'm just going to wait until the market hits a bottom and then I'm going to start investing. Well, we already talked about that. No one knows where the bottom is. So your ability to predict it is as unlikely as everyone else's. But what we can do is, if you're not investing currently, this is a great time to jump in. This is a great time to start this process. I know it sounds crazy, but it's a great time to get started, because following these 4 steps, you're bound to succeed. So this is for all investors, no matter where you're at in your journey. This information is applicable and can be applied to your life right here, right now. Today is a Sunday, but tomorrow when the market's open. So if you're hearing, if you're hearing about other people making money while the market's down, it's probably making you think, well, you're not doing something right. But have no fear. In today's episode, I'm going to cover the 4 steps that you can take to keep investing simple. What I want to deliver in this episode is simply a guide. It's just going to be a guide that you can walk through step by step. These are, they're not really sequential order, like you have to follow these step by step. But it's just how your mind's just going to flow, right? So they kind of flow one after the other. But they're not like, oh, well, you have to do this before you do this. But you'll see. You kind of need to do one before the other, and it'll all make sense. But if you do go through these 4 steps and you get started and you jump in and you get invested, I want you to know that you will be investing in a very efficient manner. I want you to know that you will be investing in a framework that has shown great success. Okay. So without further ado, I know you can't wait. So let's jump into it and get started with step 1. So step 1, don't listen to what you hear. Okay. You're probably like, what? That's step 1? I thought we were going to the moon. Like, what? No. The first thing is, don't listen to what you hear. And I have to start there because FOMO is a real thing. And when we're thinking about investing, when we're thinking about long-term strategy, the fear of missing out, it will constantly creep back in. So with that being said, you've got to understand that. You've got to understand that early on, because that's going to affect you down the road. So the biggest piece here is that every single person around you, whether you're in school as a student, whether you're at work with your coworkers, you're at family gatherings with other family members, no matter where you're at, someone's probably going to be talking about some new investment strategy that they're utilizing. Someone's going to talk about how they just got on this bandwagon and they're making $1,000 a week. People are going to talk about all these things. What I want you to remember is these 4 steps to keep investing simple. Keep investing simple. It's not rocket science. It's not something that you need people to go out and tell you what to do. It's really not that. So if people are telling you all these amazing things, tell them congratulations. Tell them good job. Keep it up. Whatever they're doing, if it's working, keep going with it. If they're happy with it, keep going with it. Because if there is a reward, there's probably a risk as well. So if they are getting these magical gains, there's a magical risk out there that goes with that reward. So don't get caught up in that. Don't get caught up in it and start thinking, well, what am I doing wrong? I'm not getting $1,000 a week. Don't think about that. Don't think about that mindset creeping in, because what you're going to be doing is working. And if these things are already things that you're doing as we go through it, just know what you're doing is working. No matter what the market's doing, what you're doing is working. So when you hear all this, all these emotions that we talked about are going to go through your mind. But I have to say this. I would be lying if I said that if you became more active in your investments, and I say like you are constantly reading financial statements, you're constantly reading charts, you're being very active, you're trading, you're trading stocks, on a daily basis. Like if you're a more active trader, could you see more gains? Sure. Could you see faster gains? Sure. But that's not what we're doing here. That's not what we're doing. We are focusing on keeping investing simple. This is the process that I'm going to take you through is you literally doing this hands-off, no thought approach to growing your account. You're not going to have to sit there and read charts. You're not going to have to sit there and read financial statements. You're going to very quickly make an analysis that's going to benefit you in the long run. And then after that, you're just going to put your money into it. Like, it's that simple. It really is that simple. So I would be lying though if I told you, if I like, oh, if you do it this way, if you do it the way I'm going to go through, you're going to make as much money as the active traders. Well, maybe not. And maybe long run, they do come out on top. Maybe they start growing their accounts faster. But on the flip side, they might lose everything that they've got while you're sitting there still building your account and growing your wealth. So this 4-step approach is not a guarantee by any means, because there's no guarantee except for that the market's going to change, and it could change up or down. But what I can tell you is that this is a tried and true method that if you will do these simple steps, there's been multiple people that have went on to become millionaires doing this. And millionaire is a term that's thrown around. And I just want to say that you can grow a $1 million investment account with very little knowledge, very little skills, very little anything. It's just following these steps. It really is just following these steps. So stick with me. But I wanted to start with this piece first, because step 2, 3, and 4, like step 1, if you don't tune out others, it will absolutely make you feel like you're constantly being left behind. You're constantly missing out. You're constantly doing this. And that's not where I want you. That's not where you should be. You should understand that what you're doing is working. Keep doing it. Okay. So step 2, this is the fun one. Step 2 is not that fun. Step 2 is stick to boring funds. If you read this quote by John Cage, if something is boring after 2 minutes, try it for 4. If still boring, then try it for 8, then 16, then 32. Eventually one discovers that it's not boring at all. This investment strategy is boring. Like this step 2, where I tell you to stick to boring funds, it's boring. This is not going to be you watching charts, reading financial statements, none of that. You're not going to be picking the next hot stock. You're not doing that. When your coworkers are talking about all these great new investing strategies and trades, you're probably not going to be involved in those conversations, because what you're doing is going to be boring. But it works. And that's the part that truly matters. So what are you doing? Well, you're going to buy index funds. Like, that's it. Like, you're just going to buy an index, and I don't even want to say index funds with an S. I want to say you buy an index fund. Like, you're going to buy a single index fund, and that's what you're going to do. So why do that, right? Like you're like, well, just one fund, that's all. Yeah, just one fund. That's all you need. Buy an index fund and put your money into it, right? That's it. Like that's step 2. It's boring, but it works. So buy an index fund. Why? Because first off, they have low fee structures. How do they have a low fee structure and why does that matter? Well, if you're paying money in fees, that's money that is not growing in your account. That's money that you're paying to invest, right? So these index funds naturally have lower management fees, or they have lower overall fees. So the reason that they have lower overall fees is because they kind of just follow the market, right? So it takes less effort to manage them, right? They're not these like super actively managed funds. So those management fees are less, which leads to less fees for you. All right. So that's one of the, that's a key component. If you're paying tons and tons of money in fees just to be invested, well, that's constantly money that's going out of your account that I guess you're getting it back, but that could be money that's growing. Why not just pay less in fees? So that's a piece that I want to ensure that we discuss because these index funds do have lower fees, generally speaking. The other part of why we're just going to focus on index funds is because they are naturally diversified. Like inside of that index fund is multiple stocks from multiple sectors, varying technically in size a little bit. So there's this built-in diversification. You don't have to buy oil stocks. You don't have to buy energy stocks. You don't have to buy tech stocks. You don't have to buy whatever stock is out there that you are interested in, airline stocks. Like you don't have to pick stocks. You don't have to pick multiple sectors of stocks. This single index fund has a multitude of sectors, completely diversified, and it just makes it easy, right? It makes it simple. We're keeping investing simple. So when you do that, you are already naturally diversified because you have switched up all your stocks into this one fund, and you've spread the wealth across multiple sectors. The other piece is that a lot of these companies are large, reputable, and stable. And when that happens, when you have companies that are large, reputable, and stable, well, the great part about that is there's less risk involved when instead of investing in some small cap growth fund that's out there, right? There's less risk involved in these large, stable, reputable companies that are built into these funds. So that's a huge benefit when we're looking at these investments, these index funds. These are three, huge benefits that make it easier for you. So to get you started, give you just a place to sort of start looking for some of these funds, I looked up and found on bankrate.com a article labeled 10 best index funds in May. First off, this isn't me recommending one of these funds over the other, so I'm not even going to do it. But I also want to say I'm not a financial advisor, and this is information used for education purposes only, so use it as that. Don't take this as financial advising advice or anything of that nature. But no matter which broker you use, you can see on this list that there is an index fund out there. If you use Fidelity, they have a 0 large cap index. If you use Vanguard, they have the S&P 500 ETF. If you use Charles Schwab, they have the S&P 500 index fund. There's another Vanguard total stock market ETF. There's tons of index funds out there. You just need to find the one that's on the broker that you currently use and go with that index fund. Okay? If you don't have a broker or you're not currently utilizing a broker, maybe this is a great place to start. Go look at these brokers and pick out which one's best for you, and then go with the fund that you thought's best. Or base your broker on the fund. Go look at some of these funds, see which one catches your eye, and pick and go with that broker. There's tons of ways to do this. It's really just you just need to pick one and invest in it. And that's right, just pick one and invest in it. There's no sense in buying more than one of these funds. Like you don't need the Invesco QQQ Trust Fund and the Vanguard S&P 500 ETF. Are they different? Yeah, kinda. I mean, they are different. The stocks that make up them are different. They do track two different indexes, but I mean, there's some stocks that's going to be in both. So just pick one and go with it, right? Like just pick the one and go with it. A lot of people follow the S&P 500 as a general index to track. So that's a good place to start. Look at funds that track the or that follow the S&P 500, and that might be a good place for you to start. But find a broker, pick an index fund on that broker that tracks one of the indexes, and go with it. Right? Go with it. That's a huge advantage. Is you just got to pick one of these, and then you're just going to put your money into it. Right? You're just going to keep putting money into that one single index fund, and watch it grow. So number 3, on to the third step. So we've been through 1 and 2. So number 1 is don't listen to what you hear. Number 2 is stick to those boring funds. And number 3, you are going to keep buying during ups and downs. That's right. Buy low, sell high. Isn't that what they all say? Buy low, sell high. Well, guess what? You are going to buy low. You're going to buy high. You're going to buy in the medium. You're going to buy low again, and you're going to just buy put money into that index fund over and over and over again. So no matter if the market's down like it is right now, keep investing. If the market goes up, keep investing. That's the goal here. The goal is to buy during all phases of the market, ups and downs. Just keep throwing money at the account. I promise you it's okay, because it has a long track record of producing positive returns over time. I'm not saying yearly, I'm saying over time, and that's what we're focusing on. So first thing when we look at keep buying the ups and downs is you cannot chase returns. So when we look at those funds that I provided to you earlier or showed on the screen earlier, you can't go and look at those funds and be like, well, this year, this one put out a 12% annual return and that one put out an 8. So I'm going to go with the 12% return. Okay, good assessment. I got you. I'm with it. So you go and look, these are the yearlies, right? Then the next year you look and you're like, oh, well, this other one now put out a 12 and this one put out an 8. So I'm going to sell off and I'm going to switch to the other one. Not a good idea. When you're picking these funds, the best strategy is to look at a 10-year history of the fund. Most really solidified funds have been around for 10 plus years. They have a 10-year history. Go and compare funds based off a 10-year history. If a fund has been able to sustain gains through 10 years, it's a pretty solid fund, I would say. It's a pretty good place to start. Go compare funds off their 10-year history. Now, when I say don't chase returns, that also means after 5 years of investing in this one that said I was going to get a 12% return, it only got an 8% return, and all the other ones are getting a 10% return. Don't just sell because you're getting an 8% return. Everybody else is getting a 10. Don't chase returns. Now, if the fund said I was supposed to get a 12% return, 10 years it was doing 12% return, and now it's doing a 4% return, and the rest of the market's doing 10. Yeah, you could probably switch that one. Like after 5 years, I'm not saying yearly. After 5 years, if you're like, man, this thing's averaging a 4% return and it was averaging a 12, I might look at it. That's totally underperforming the rest of the market. I may switch that one, but otherwise, I'm not just going to go around switching funds because mine's not doing as good as another one, because the next year it might flip. The next 2 years it might flip. So don't just go around chasing returns. It's not worth your time. Just keep putting your money into that fund that you picked and watch that thing grow. The other thing you cannot do, as I've said this before, is you don't try to predict the market. You can't do it. The only predictable thing about the market is that the market is going to go up and it's going to go down. All right. Both are a change. That's the only thing that you can predict, is that the market's going to change, and that's it. So which direction it goes is out of your control. So don't look at that and don't try to control it. Just keep investing when it's up. keep investing when it's down. Don't try to time the bottom. Don't try to time, oh, I'm not going to invest right now because it looks like it's at a high and it's about to come back down. Just put your money in the investment and just keep going. Don't think about this stuff. We're keeping investing simple. We're not trying to overthink this thing. Put your money in there. Every month, put a certain amount, or every week, put a certain amount. However you strategize to do this, just keep putting it in there a certain amount. And I'm telling you, you will win with your investment. Last piece, and this is my favorite. Step 4 is my favorite, and I can't wait to discuss it, but it is double your money every 7 years. That's step 4. Double your money every 7 years. And you're probably like, what the heck? How is that a step? What do I do with double your money every 7 years? How do I double my money every 7 years? Well, first off, every 7 years it comes from historical return on funds. It's a guideline. It's a time frame that you can use as a good planning number. But pretty much it comes from the fact that historically, if the market returns what it does, just over 10%, it takes you 7 years to double your money. That's where that comes from, and that's why this is step 4. So if you're curious, you're probably like, okay, so what does that mean to me, and how do I do it? Like, why if it's just going to double every 7 years, how is that a step for me? How's there something I need to do? Well, I think that it is completely a step for you. And I'm going to show you how. Because whether you realize it or not, you are in control of how much is doubling, right? If we break it down to its simplest form, you're in control of how much is doubling. So if, let's say you build an account and you get it to $50,000 in your first year, for easy math. 7 years from now, that account would be $100,000 using this guideline. After another 7 years, that's now $200,000, right? That's sort of this mindset, and that's where we have to really think about how this whole entire piece is that you're in control of how much is going to double. So if you only build that account to 1,000, well, that's going to double to 2,000, right? Big difference in 50,000 to 100,000. So whenever we think about this and wherever we're like, okay, how am I in control of that? Well, you're in control of how much money you're able to get into that account to double in the next 7 years. So how big that account is, how small that account is, that's where you're in control. So what I want you to know is that that's a time thing. You have 7 years. How much do you want to double in 7 years? Do you want that account to double from 10 to 20,000? Do you want it to double from 20 to 40,000? What do you want it to double and then get to that number? That's your goal. That's your step 4. Your step 4 is to grow your account by you putting money into it so that when that 7 years is up, you are proud of what that doubled to. So the biggest piece is every single day matters when it comes to this. So if you wait to open the account, if you're not currently investing and you wait to open that account, this process is going to take longer. If you wait to fund your newly opened account, this process is going to take longer. If you don't make regular deposits into the index fund you chose, this process is going to take longer. No matter what you do, this process every 7 years it's going to double. Whatever you put in there, every 7 years it's going to double. So that's the part that I want you to see. So if you're looking at this on the screen, you can see the 7.2 years is the time frame for a 10% return, and that's sort of where the 7 years comes from. If you were able to pull a 12% return, you're looking at about 6 years for it to double. But it really depends. But what I want to show you is at the bottom, and this is especially or to the right, excuse me. And I'm going to try to walk through this for those that are listening on the podcast. But this is a double your money chart. And I think this is important, not for a lot of my middle age to older listeners, not as important, but still applicable. But I think this is why it's so important that we teach our kids about money. And I think this is why it's so important we teach young adults about money. Because if you look at that doubling periods, what I want you to realize is ultimately the doubling period is based off the rate of return. I got it. But let's use the 7, for instance. That means that looking at this chart, it would take you 77 years for $1,000 to turn into 2 million, right? Looking at that chart, it would take in 77 years, $1,000 could turn into 2 million. So if you helped your child start invest or buying an index fund early on, by 77, they would have $2 million, right? With what you helped them start. But the part that I want you to really look at is this is not them putting anything else into the equation, right? This isn't them putting more money in. This is if you put $1,000 in an account for a child at birth, that $1,000 would be $2 million untouched in 77 years, right? And that's the part that's the mind-blowing part of this whole strategy, is that these are untouched amounts. You're still putting money in all along. These are untouched amounts. And when you look at this chart and you're like, okay, in 3 doubling periods, I'm able to take $1,000 and it be, in 21 years, it's 8,000. Well, like, that's not touched. You're still putting money aside, and that's only being $1,000. But what I'm saying is this: think about those bottom numbers. Those are still only 7-year increments. That's the part that I want you to realize. Those are still only 7-year increments. From $512,000 to $1,024,000 is in 7 years. That's mind blowing. In the same 7 years it took you for your account to grow from 1,000 to 2,000, your account grows from 512,000 to 1,024,000 in the same 7 years, right? That's mind numbing that's how it works. But that is exactly how it works. So I say that because I think that's the part that is hard for people to realize. It's truly hard for people to realize because it's backwards of what people want. It's opposite of what people want. But what you have to understand is that when you're doing investing, you're investing for a much longer time frame, right? So the market, what it's doing right now is A-okay. You're buying on a bargain, right? All the money you're putting in right now, you are buying at a bargain. If it keeps going down, you're just getting a better deal. And as soon as that market turns and it starts to go back the other direction, all these cheap investing prices that you've been able to buy in over the past, 5 months with that negative 18% downtrend or year-to-date return, that's money that you're going to win on that when that 18% recovers. You're going to win, right? So because what you buy right now, if 18% recovers back to zero, what you bought today would have an 18% return on it, right? You see what I'm saying? So that's the part that we've got to get to, and that's the part that we have to understand. That's the part we have to teach to young adults. We have to teach to children. We have to teach time and time again. And then as an adult, we have to live it. We have to show that. We have to be that example, because how we invest is opposite of what we want. And this is the part I was getting to, is that if you start investing right now, the time it takes for your money to grow is much slower on the front end, right? I mean, it's slow on the front end. I got it. It's boring and it's painful and it doesn't really move that much and it's hard to watch. I got it. It's hard to see that money. You're putting all this money in and it's not doing anything. But what I want to challenge you is look on that screen. Listen to my voice if you're listening on a podcast. In 7 years, an account grows the same amount. In 7 years, an account was able to grow 1,000 to 2,000, as it is able to grow 512,000 to 1,024,000. You see what I'm saying? Like, it will grow fast. In another 7 years, that 1,024,000 would grow to 2,048,000 in 7 years. So I challenge you. I challenge you to get on board. I challenge you to keep investing simple. This does not have to be complicated. Don't make it complicated. The more complicated you make your investment strategy, the harder it is for you to buy into it. The harder it is for you to keep going. The harder it is for you to keep doing it. So don't make it complicated. It doesn't have to be. Pick an index fund that's boring, that has great 10-year returns, and go for it. Start buying it. Start put money into it now. Like, don't wait. But you can see this is an easy 4 steps. Don't listen to others. Invest in the boring funds. Buy the ups and the downs. And then double your money every 7 years, right? Like, that's the 4 steps. Like, that's easy. It's easy to do, easy to follow, super easy guideline. Just don't wait. The biggest thing is just don't wait. Keep going. Now, in the end, if you do all this and you keep investing simple, you will be grateful. The market's going to be grateful for your long-term investment, and you will be A-okay with your strategy. So get started now, and you'll be on your way. Now, as we wrap this up, I want to say thank you all for listening. But if you are ready to take control of your finances, or you just need someone to help you along the way, I am here to help you do that. Head over to thefinancialmirror.org and find the website and click book now on the home screen. If you're watching us live, you can see it. I just threw it up on the screen so you can see it. The book now right in the middle of the screen. If you're listening on a podcast, just go on over and click the book now in the middle of the screen at thefinancialmirror.org and get your free consultation taken care of. I can do financial coaching. I can help you with this investment. If you just want to look at funds together, I'll happily walk you through, showing you where to look, showing you how to navigate it, and we'll get you started. We'll get you started investing so you can take advantage of that power of doubling your money every 7 years. In addition, if you do want to show some extra support to the stream, head over to thefinancialmirror.org/shop, and you can buy some awesome Financial Mirror gear. So head over to the shop, check it out, see what's out there that you would like, and all of those products are price to cost and just are out there so that you can help grow awareness to the brand and the community. More importantly, if you are listening to this on the podcast, please don't forget to leave that 5-star review and a written comment. Both of those go a long ways in helping getting this word out, helping more people find this personal finance information so that they can get on their way to having some of the great success with their finances that you are. Thank you so much for joining. Thank you so much for listening. And I am so excited to hear more about all the success that many of you are going to have following this episode. Till next week, continue improving the one thing you can control: yourself. Peace.
Well, that wraps up today's Financial Mirror. Join us next week as we continue to work on ourselves, change our mentality, and to commit to achieving the success we always envisioned. Regardless of your platform, help us grow as a community. Please like, subscribe, and share with the people in your lives.